It's in the zeitgeist, it's non-consensus, but with nominal GDP where it is, with the spirit of Atlanta GDP now, what if rates go higher? How does BlackRock and how do you, Amanda Lynam, frame out a 2-year at 5.05, 5.10?
Sure. Good morning, and thank you, first of all, for having me. I think, Tom, what you're raising is the reason why we think that there's not really a sense of urgency for the Fed to normalize policy, and even when they do, it's likely to be a shallow cutting cycle. So for corporate credit, that means we shouldn't be banking on significant near-term interest rate relief. I think the tail risk that we're watching, and the longer that rate cuts get delayed, I think lends more credence to this possibility, is that of a rate hike. And a rate hike would not be negative for credit because of the incremental 25 or 50 basis points mathematically. It would be more negative for credit because of the uncertainty that it would interject related to the forward path of monetary policy. That's not a great backdrop for credit. That's not a great backdrop for deal making, specifically kind of sponsor-related M&A. And so that's what we're watching for. It's not our base case, but it's a concern, and that's really the risk.
Sponsor-related M&A
yeah.
is when the kid asks you if they can go to the third lacrosse camp this summer. That's what sponsor-related means.
So, Amanda, I can sit here at a 2-year treasury like a lot of investors here and get close to 5%. That's not a bad trade. Or should I take some credit risk, do you think?
So we like taking credit risk and floating rate exposure.
Okay.
Leverage loans, for example, up around 3.5% year to date, outperforming high yield up around 1.5% total return.
Okay.
IG is lagging because of the duration exposure. I think importantly, if you're deploying money in corporate credit, you need to be deploying for income and yield, not for total return. We shouldn't be banking on a significant rally in rates to really kind of juice those total returns, nor should we be banking on material spread compression because spreads are already quite tight. So really the conversations that we're having in capital deployment and corporate credit is really about locking in those yields.
I'm going to get you in trouble. It's confusing, folks. There's BlackRock, there's Blackstone, there's BlackRock, which is the building CBS is in over, I think it's on 6th Avenue. Amanda, I'm going to get you in trouble here. If we get a rate regime higher, what does that do to private equity and private credit valuations? My math doesn't work.
Yeah. Somewhat counterintuitively, Tom, against this backdrop of high for longer, we've seen covenant defaults in one of the private credit indices that we track decline for 4 consecutive quarters, which is a bit of a counterintuitive result. It speaks to the flexibility that is inherent in this long-term lender-borrower relationship. I think the point you're raising is also applicable in the public markets. And for a given company with a given business model and a given macro backdrop of, say, higher for even longer, they're probably afforded more flexibility in the private markets relative to the liquid. However, I do think that when you're thinking about sponsor-related M&A, so again, not strategic companies buying other companies, but more LBO activity, financing is a major component of that equation.
Right.
And so it would likely keep that sort of activity muted.